Hello and welcome to this video. We will be running through the concept of contango and backwardation. Now firstly, we need to understand the basic concepts of a futures contract. Now a future is a derivative where the value of the contract is based on the price of a specific asset, such as a barrel of oil or even an ounce of gold. In a future, you will have a buyer and a seller, where the buyer agrees to purchase an asset from the seller at an agreed price at some point in the future. When the future date occurs, in a physical settled future, the asset will be transferred to the buyer and the cash handed to the seller. Now, to help understand this concept, I'll run through an example where a buyer has agreed to purchase a barrel of oil at $60 2 years in the future. Now that the contract has been agreed, we will go 2 years in the future to the maturity date for the transaction to be completed. Now, whether the buyer will profit from this future transaction will depend on what price a barrel of oil is trading at in the market at maturity. If a barrel of oil now trades at $70, then the buyer will still have to purchase the barrel from the seller at $60. So theoretically, they have made $10 profit, as they can sell that barrel straight away for $70 in the open market. If, for example, a barrel of oil was only trading at $50, then the buyer still needs to fulfill that contract and purchase the barrel from the seller at $60. So they would now theoretically make a $10 loss, as the buyer would lose $10 if they sold it in the market straight away. One key point to note is that the price agreed in the futures contract will be dependent on the length of the contract. If the contract is short, say 6 months, the price agreed in the future will most likely be similar to the price currently traded in the market. However, if the contract length is long, say 5 years, the price in the future could be significantly different to the price traded in the market currently. As the time to maturity can vary in a futures contract, you can plot a curve that illustrates the relationship between the time to maturity and the price agreed in the future. Below is an illustration of how the price may change when the length of the contract increases. You can see that when the time to maturity increases, the price agreed in the future also increases. When we see this relationship in reality, the market is said to be in contango. Given that prices of assets can change daily, the future curve will also change if there are events that materially impact the value of an asset. Below is a new illustration of a future curve where the prices have shifted. In this case, as the time to maturity increases, the agreed price, which is fixed, has decreased. This means the seller in the contract is willing to sell the asset at a cheaper price in the future than they would today. This relationship is known as backwardation. We will now run through the key factors that influence whether the market would be in contango or backwardation. The first factor relates to the drawbacks of holding the asset. For example, the storage costs. If the storage costs are high, the price of the asset will usually be higher than the price today, as the seller has to take the hit of the storage costs. A second factor that influences whether the market's in backwardation or contango is the benefits of holding the asset. For example, if the asset is an equity stock that is expected to pay a large dividend in the future, then the price could be higher today if the stock ownership is transferred, as they will receive the dividend as part of the contract. If the stock equity was only transferred in the future via a futures contract, the buyer may miss out the dividend payment, and therefore that would be priced in to the fixed price agreed in the futures contract. Now, another factor that will impact the price agreed in the futures contract will be the expectations of future supply and demand in that asset. If there is an expectation there will be large levels of supply in the future, then the price agreed in the futures contract will likely be lower than today's price, as there will be an expectation of oversupply sometime in the future. Thank you very much for watching this video. I hope it's brought more insight into Contango and backwardation. Please feel free to leave a comment if there's a topic you would like me to cover in the future. But it's goodbye for now.